one that I point your eyes to that we haven't focused a ton on, we focus on it obviously, but we've always talked about this rate of change in non-farm payroll growth, is the tweet that Christian has on implied income growth for August. So again, and it's pretty easy. I mean, if you look at income is a function, I assume, of if you have a job, okay? If you don't have a job, your income growth is going where? It's probably going down, okay? Unless you get helicopter money, of course, which is possible. That's why they want to give people helicopter money. So if your income growth is going down, then, you know, if you just look at, Christian does a great job with this. He's got the arrows, equals this thing called consumption growth going where? Probably goes down, unless you can get another like 25-year lease on a car. That didn't seem to work at Ford or GM yesterday. So income growth goes, jobs weaken, income growth weakens, consumption growth falls. Absent, to this point, and Ray Dalio has spent a lot of time talking about this, the credit mechanism, absent getting people giving you free money or really cheap money to offset your declines in income. Because that's kind of like one, it's not socialism, it's the art of lending in late cycle. Jamie Dimon's done a lot of that, for example, at JP Morgan. So really think about those relationships and why the consumer in particular, in the macro deck we showed on slide, I believe we showed on slide 25. But if you look at the top 50 hedge funds by assets under management, the number one sector that they own currently, as a percentage of their total holdings, consumer discretionary. Okay, consumer, that's what everybody thinks is fine. And they thought it was fine in 2000. They thought it was fine at the end of 2007. They think it's fine now. At the end of the cycle, you always think that that's fine. Again, as a very baseline reminder, I should have put this at the top. When you calculate GDP, that equals C plus I plus G. Okay, put a little plus in there. And then you net out exports and imports. So this C represents roughly 70% of GDP. Okay, so that's why it matters. I'm obviously not a very brilliant guy. I don't have any Nobel laureate beside my name or any PhD. But I think everybody should understand these very basic relationships. I think the art of establishment economics is obfuscating that. I mean, don't obfuscate it. It's very simple. I mean, it really is simple once you understand the complex to simplify it. Understand where jobs are going, income growth's going, consumption growth going, and you'll start to get the next phase of GDP growth slowing right. Currently, as you know, a lot of the slowdown has been right here. That's called investment. So again, people don't want to invest. They have a Federal Reserve that could, on any given Friday, on a Powerball number, completely change the cost of capital or the forward outlook on pricing for commodities. I mean, that's crazy. You know, people who run businesses and spend their whole life trying not to fail as a business operator, of which a lot of small businesses do, they're not willing to put their family and their wealth and their sense of well-being and all that they've accomplished on the line for a couple people at the Federal Reserve. No, no, no.
Fed doing their darndest to job-own rate hike odds up to hiking threshold ahead of the September meeting. Hard, though, against all this transitory data. And I'm going to add a little bit to that, don't you think?
Yeah, don't you think? Transitory, let's put that one up. I had to find a reason to go to the board. Transitory. I think that's how you spell it. Commonly referred to as transitory data. When, and again, this is a Janet Yellen definition, and Ben Bernanke, by the way, the data is only transitory when it's going this way. When the data is going the other way, it's not transitory, okay? Because this is effectively the main problem or the prescribed outcome problem that the Federal Reserve has. They would like both inflation and growth to go up to their targets so that they could raise interest rates and finally get out of this Ziploc bag that they've been trying to get themselves out of for a very long time. So again, transitory, you could equally couldn't you call the bounce in oil prices being transitory? In other words, that would be an inflation pressure, wouldn't it? Going away. So when inflation starts to go down, why doesn't the Fed call that transitory? I wonder. Are market prices that go down non-transitory, but market prices that go up? It's really hard to kind of like figure it out. If market prices are going your way, they're non-transitory. But if they're going away from what you predicted, which is wrong 70% of the time, they're called transitory. So again, this is at this point, and I wrote this morning in the early look, measuring and mapping data in rate of change terms is trivial. There is absolutely no word transitory that you need to use to qualify what's happening versus what you would have liked to see happen. Okay, so something like inflation, for example, there's this thing called the 5-year break-even rate. So 5-year break-even rate is currently at like 1.29 or 1.3%. That's a pretty good proxy. Ben Bernanke used to say that that's a pretty good read-through on inflation. In other words, that's not 2%. It was higher than that. The rate of change had come down. And that's when the Fed kept, started to say, hey, look, inflation, this is when oil was at 51, 52, before wheat prices crashed back down to their lows. Cattle prices, pick your pony. Rents have started to back off because the housing market has started to cool. Again, this is the level of inflation that the market expects. So it is very much inconsistent for the Fed to not call this transitory. Transitory. That should go both ways, guys. Be straight up with people.
I'm certainly getting smarter today.
Well, all these words, you gotta stay up with the nomenclature. The other thing that's going on is what you want to do. They don't like being called data dependent on a data point now because they realized how stupid that was. Because one jobs report could have made them go into a series of rate hikes into the worst ISM services number since 2010. I wonder why. Oh, and by the way, a recessionary ISM manufacturing number. So they said, well, we're not data dependent in terms of one data point. We want to look at the swath of data. So a series of data points. So we did that. We showed it. It's up on hedgeye.com. I think if you have it, I tweeted it actually this morning a couple times, Josephine. Is the data getting better or worse in its most? Oh, there it is. Okay, Chicago PMI worse. ISM services worse. Manufacturing side of the ISM worse. If you want to look at a different, if you don't believe the ISM manufacturing, you want to look at the market manufacturing. That's MARKIT. It's a different survey. Same people, or at least kinds of companies. Confidence worse. Non-farm payrolls worse. Auto sales way worse. Oh, and that labor market conditions index, which he used to say mattered more than anything else, worse.
Here on the JOLTS data. So JOLTS were up on an absolute basis yesterday. Any key takeaways?
Go for it. You're the guy who gets to look at JOLTS. Imagine you're Christian Drake. He's like, it's JOLTS day.
Yeah,
got to analyze all the JOLTS.
Yeah, the JOLTS data was up sequentially yesterday. But again, this isn't a surprise. So what you have to remember is that the JOLTS data is a month lagged. So the JOLTS data is reflecting the employment situation in July, and July was a decent number, at least on the NFP print, up 275. So what you're seeing is a partial reflection of that. Openings were up, hirings were up a bit. One thing that we like to look at inside of the report is this is the churn. So we're talking about gross flows in the labor market, and you see the NFP report every month, and it says up 100,000, up 200,000. But what you forget is that the labor market is a lot more dynamic than that. So every month, something like 5.5 million people are hired. Something like 5 million people lose their job, either quit or some other form of separation. So on a gross basis, you really have about 10 to 11 million jobs gained or lost collectively. And what that reflects is basically the total dynamism in the labor market. And you like that in a fluid, kind of well-functioning economy. People are leaving jobs, people are getting jobs, people are changing jobs. And that tends to reflect the broader cycle as well. So if you take total hires plus total separations and look at that, and that's your proxy for that dynamism, you see it peak late in the cycle and roll off. And what we've seen here is it peaked at, I want to say, 10.7 million into the end of last year, first quarter of this year, and now we're down towards 10.1 million here currently. And usually when that peaks and rolls, you don't see a a reinflection and kind of re-breach to a new high on the upside. So
it's a lot of stuff.
Yeah.
You know, we've had a lot of, and thanks again for all the feedback. We've had a lot of feedback on the kind of the educational component of Hedgeye. So sometimes like right now, after Christian says a lot of stuff, I want you to get better at understanding what the hell what he's saying. Because when he's speaking mathematically. That's the way we speak to each other internally when it comes to analytics. When it comes to other things, we don't talk that way because that's nerdy. But net, you know, when he talks about the sequential, so I wrote it down here, the sequential versus the year-over-year rate of change. They're both rates of change. They're on a different duration, okay? So sequential means quarter over quarter, okay? Or month over month, I should say. Or week over week. I mean, it really is a shorter term. So you can go week over week, you can go month over month, you can go quarter over quarter. Okay, that's the sequential, shorter term rate of change. The year over year is the trend, okay? The trend is your friend. If you get the big trends in macro right, you can go start your own asset management firm. You could be big time. You could be 2 and 20, big time. Again, getting big rates of change right when they go from bearish to bullish, that's called a phase transition to bullish. We went there on U.S. equities coming out of 2009, coming out of 2012. That's awesome. In as much as going the other way is awesome. So again, going the other way on bonds, for example, in 2013, they were about to go from bullish to bearish. So we went bearish on bonds, we went bearish on gold, all the things that we like now. But again, getting the rates of change right within the continuum of a sine curve is critical. Because you can have many head fakes. Like Christian said, the JOLTS number sequentially was better. Okay, JOLTS is coming off this level, is it not, in terms of year-over-year rate of change?
Yeah.
So it's coming off here, but when you're coming off here year over year, so the cycle has peaked, you can get little data points here, but then if you get more here, you're still going like this. Right? You smooth all this out, it'll eventually look like a cycle. So there's all these little dots, you know, like they're all, you know, but when the preponderance of dots are going this way, as opposed to like one off over here, like the July jobs report. Mm-hmm. The July jobs report, which wasn't a JOLTS part of July? Is that what the JOLTS
Correct.
was? Yeah. July was an anomaly. It was a dot right here. Can you see that little dot? It actually wasn't up there. It was like more like over here. X that one out. Right over there. So everybody goes, oh, look at that dot, look at that dot. Oh, that's what I've been looking for. That's what I want. I look ridiculous when I explain it that way because it is ridiculous. You know, global macro data is wavy. You know, it's glacial. It changes at a snail's pace when you look at it from a long-term perspective. When you look at it on a week-over-week basis, or how some of these hedge funds have to perform week-over-week, day-over-day, and month-over-month, I mean that's what's happening there. It's impossible. You can't do that. Or at least you can try, but I mean, it's getting a lot harder when there's a whole lot of nothingness going on. So anyway, something to think about when you hear about data being sequential and or year-over-year from a trending perspective. So we could say JOLTS was bullish sequentially, but reaffirms that the trend has peaked on a year-over-year basis. Got it? Technically correct?
Yes.
Mathematically correct?
Yes.
And for your required reading tonight and over the weekend, please look up the difference between the secant, S-E-C-A-N-T, and the second derivative.
Tangent.
The tangent. They're different. Right. Should I tell them what the difference is? Here's actually the difference. The tangent line is here. That's the tangent, okay? The secant is here. Yeah?
2 points of intersection.
2 points of
average.
intersection.
Yep.
All this stuff really matters. You have to understand this. I know people have been lulled and mulled and mauled and enthralled into believing that the moving monkey is some kind of god king. That is so old, the equivalent of 16th century chemistry, that I can't tell you. get with the program. Even if you're not good at math, you can get to the basic premises that we're talking about, and you can teach yourself.